Most investors looked at 2025's double-digit gains and assume 2026 will be more of the same. But my 38 years of experience working with the markets has taught me that the biggest risks are usually hidden right in plain sight. Today, I'm breaking down the data you need to see to prepare your portfolio as we begin into the new year. Hello, I'm Suro Ghatak, Director of Investment Management with the Noble Group. To truly understand what lies ahead in 2026, we first need to start with how we got here. In 2025, the U.S. equity markets, as measured by the S&P 500, were up almost 18% for the year. This marked the third year in a row that the markets were up in excess of 15%. These are extraordinary returns, with the trailing 5-year returns of the S&P 500 clocking about 14.4%, well above the long-term trend of 10%. However, it wasn't an upward trajectory the entire year. Tariff uncertainties beginning in early April brought the market down almost 15% on the year. However, those who bailed on the market during this downturn missed a market rally of almost 38% on the other side. Time in the market, not market timing, is what wins in the end. And 2025 was a perfect example of this. The international markets also did well, with the Morgan Stanley All-Country World ex-US Index returning 33%. Admittedly, a declining US dollar added a boost of almost 8%. The bond markets, as measured by the Bloomberg Aggregate Bond Index, delivered returns of 7.3% as inflation concerns abated and recessionary fears proved to be unfounded. After an abysmal 2022, when the aggregate bond index was down 13%, bonds are back to their role as shock absorbers for a multi-asset class portfolio. What was behind the strong performance of the U.S. equity markets? First and foremost, strong earnings. The earnings for the S&P 500 in aggregate were up 11.5%. The key driver of earnings were the Magnificent Seven stocks and the technology sector, which delivered earnings growth more than 20%. The international markets benefited from improving relative earnings, easier monetary policy, and investor recognition of more attractive valuations. So now, let us consider what lies ahead. First of all, by most measures, the global economic outlook is good, and monetary policy worldwide generally favors easing. The U.S. consumer spending remains strong, admittedly dominated by the high-end consumer. Inflation remains relatively subdued, aided by lower shelter costs and energy prices. Credit metrics for U.S. corporations and consumers remain mostly healthy, although there are early signs of distress with low-end consumers and those hamstrung by the need to pay back student loans. While the inflationary picture is much improved with the core CPI at 2.7, it remains above the Fed's goal of 2%. Given the lack of fiscal discipline by the U.S. government and burgeoning federal deficits, there is a distinct possibility that long-term fixed income rates could rise. It is not the best time to make an aggressive interest rate bet. Focusing on the equity markets, I look at three things: earnings growth, valuations, and technicals. Earnings are the lifeblood of the stock market. Earnings for the U.S. market are expected to grow 15% in 2026, according to J.P. Morgan, driven by a 20% plus earnings growth from the tech sector. But the broader market is expected to grow earnings by a respectable 12% as well. These are good numbers, but could prove to be a bit optimistic given the euphoria about AI investing. For valuations, we use a number called the price-to-earnings ratio, or the PE ratio, to judge the valuation of the market. In simple terms, it is a measure of how much an investor is willing to pay for every dollar in earnings power of a company. Valuations are definitely an area of concern, with the forecast price-to-earnings ratio at 22 times. Unprecedented except for the tech bubble in 1999, where the valuations exceeded 25 times earnings. To put things in perspective, the 30-year average price-to-earnings ratio for the market is about 17.1 times earnings. Should interest rates back up a bit, we could see a slight shrinkage in the market valuation, offsetting the earnings gains. Technicals remain favorable, with large balances of cash and cash equivalents on the sideline despite the market rally in 2025. The proverbial dry powder for market rallies. Consumer sentiment at 52.9 is subdued and, as a contrarian indicator, suggests market upside. However, within the equity markets, there is clearly a speculative risk-on mentality by retail investors and warrants caution in certain areas such as AI and cryptocurrencies. Good old-fashioned demand and supply dynamics are also favorable for the stock market. Stock buybacks of almost $1.2 trillion helped stock prices in 2025, and we can expect that to continue in 2026, albeit at a slower pace. Flows into defined contribution plans are a big source of demand for equities as well. Over $800 billion in contributions flow into defined contribution plans. Of this, about three-quarters goes into equity investments. That's $600 billion coming into the stock market each year. Putting it all together, I think it is important to stay close to your target asset allocation, given that most assets are trading at the higher end of their valuation ranges. In an environment where equities and bonds are priced for perfection, adopting a high-quality posture would be a good idea. The U.S. market has been dominated by large-cap growth stocks the last 3 years, and while it may be premature to call the demise of the AI theme, it may be a good idea to diversify your investments into areas such as dividend-paying stocks, value stocks, real estate investment trusts, and international companies. Historically, there have been 4 instances where the markets have had 3 back-to-back 15-plus returns, like we just had. In 3 of those instances, the market was up 15% the subsequent year. However, I think planning for a high single-digit return would be a more realistic expectation, given the many uncertainties ahead, such as inflation, tariffs, long-term bond yields, and the sustainability of the AI investment themes. Now, regardless of what this year ultimately brings us, during my 38 years working in the financial industry, I've found there's 7 key rules that govern the stock market. And if you understand them, they can help you make more informed decisions with your money. Click here to watch, and I will see you there.